Hi. Let's learn about the subject of covariance today. Covariance measures the directional relationship between the returns on two assets. A positive covariance means asset returns move together, while a negative covariance means they move inversely. Covariance is calculated by analyzing return surprises or multiplying the correlation between the two random variables by the standard deviation of each variable. Covariance evaluates how the mean values of two random variables move together. For example, if stock A's return moves higher whenever stock B's return moves higher and the same relationship is found when each stock's return decreases, these stocks are said to have positive covariance. In finance, covariances are calculated to help diversify security holdings. The formula for covariance is sum of the product of the deviations from the mean of two variables, divided by the sample size minus 1. Where deviations and returns are calculated using the daily returns for the selected stocks or funds over a period of time. The covariance equation is used to determine the direction of the relationship between two variables, whether they tend to move in the same or opposite directions. A positive or negative covariance value determines this relationship. A positive covariance between two variables indicates that these variables tend to be higher or lower at the same time. When graphed, the data points will tend to slope upwards. A negative covariance indicates that the two variables have an inverse relationship. When charted on a two-dimensional graph, the data points will tend to slope downwards. Covariances have significant applications in finance and modern portfolio theory. It is used in the capital asset pricing model to calculate the expected return of an asset, as well as in portfolio theory to statistically reduce the overall risk of a portfolio by protecting against volatility through covariance-informed diversification. Covariance and variance both measure how data points are distributed around a calculated mean. However, variance measures the spread of data along a single axis, while covariance examines the directional relationship between two variables. Covariance measures the direction of a relationship between two variables, while correlation measures the strength of that relationship. A correlation is considered strong if the correlation coefficient has a value close to +1 or -1, indicating a positive or negative correlation respectively. The covariance between two stocks is calculated by summing the product of the deviations from the mean for each stock's returns, divided by the sample size -1. Here are 5 key takeaways. 1. Covariance is a statistical tool used to determine the relationship between the movements of two random variables. 2. When two stocks tend to move together, they are seen as having a positive covariance. When they move inversely, the covariance is negative. 3. Covariance is different from the correlation coefficient, a measure of the strength of a correlative relationship. 4. Covariance is an important tool in modern portfolio theory for determining what securities to put in a portfolio. 5. Risk and volatility can be reduced in a portfolio by pairing assets that have a negative covariance. Hope this would help. Thanks for watching.